I want to talk to you today a little bit about 20 and 30-year mortgages and the difference. My name is Amy. I am not a financial advisor. I'm just sharing with you personal finance info I know as someone who's really passionate about it and has worked in accounting for many years, and my degree is in finance. So I know a thing or two about this, and I definitely nerd out on numbers, specifically around personal finance. One of the most interesting things I found in my own journey of home buying is how much you will save in interest when you get a 20-year mortgage versus a 30. Now, when you're looking for houses, you can ask your lender to send you a breakdown of what your closing costs will be, what your monthly fees will be, and within that, based on an approximate of your house price, they will also send you info on how much interest you would pay over the lifetime of your loan in the 30 or 20 years. You will notice that in a 30-year, you are paying almost the same amount as the price of your home. So let's say your house is $200,000. You will pay about $200,000 extra in addition to that in interest. So that's about $400,000. If you compare this with a 20-year, for the 20-year, the amount you're paying in interest is usually at least a third less, depending on what your interest rate is. That's because it's less of a risk for the lender. You're only borrowing for 20 years as opposed to 30. And also because the interest rates are usually lower. If your lender is making the 20-year higher, that's a little scammy because it gives me the ick. Go with someone else. You can use them just as a comparison for interest rates if you want, but I personally would definitely be going with a different lender, and that is exactly what I am doing. I also want to point out that when you look at what your monthly payment is on a home at the $200,000 price point, it's usually only a difference of about $150 to $200. To me, that difference is significant because it is a huge amount of money that you are saving over the lifetime of your loan. And if you plan to buy another house and sell this one in the short term, more like 5 years, let's say, you're putting almost 80% of what you pay in those first few years toward the interest anyway. So you're going to end up paying more, even if that's what your plan is. In that case, you could even look at the 5-year adjustable rate, which I have been learning a lot about. I know it sounds scary, but that would make more sense if you knew you were only going to be owning it for a little bit. But again, the 20-year is still the way to go. If you want a reference point, you can ask ChatGPT, put everything in and it will calculate for you. Ask them, how much am I going to pay in interest with these terms? In 5 years, how much of my mortgage will actually be paid off? These are really important tips that most of us just do not know about if we're not interested in this really boring topic for most people. Let me know if you have any questions.